Hi everyone, welcome to this month's Financial Markets Update. I'm Piers Bolger, the Chief Investment Officer here at Viridian. Well, August has been a really interesting month for financial markets, both domestically as well as globally. On the domestic front, we've had the company reporting season and we're by and large around about 3/4 of the way through that. And in our take, it's the reporting season's been probably flat to slightly disappointing. The earnings outlook and certainly the earnings surprise of corporates has been below what market expectations were at, only marginally, but certainly from our perspective a little bit weaker. When we look at actually the segmentation side of it across the market, we've seen some really quite divergent moves. For example, with the tech sector has had a big miss in regards to market expectations, as well as the telecommunications sector. On the flip side, the only positive sector to date that's reported in terms of market expectations were financials and diversified financials within that, which was up roughly around about 4%. When we look at the forward outlook, equally we're sort of seeing a more moderate earnings outlook. EPS growth into next year is only moderately positive, sort of 2.5–3%. Comparing that to the prior reporting period, the earnings outlook was roughly around about 5 to 5.5%. So we've clearly seen a moderating outlook in regards to corporate activity. Why is that occurring? And really that leads back to the macro side of things, and particularly around the ongoing trade dispute between the US and China, which we believe is really now starting to have an impact, not only in terms of economic activity globally, but equally in terms of financial market returns and just how investors are feeling about putting money to work in higher risk asset classes. The benefit of that in terms of the asset allocation side of things, we've seen bond markets rally. Our 10-year bond's roughly around about 60 basis points lower. We're now seeing our 10-year bond, below 1%. And in the US, we've seen their long end of the curve also come back pretty significantly, roughly around about 80 basis points to around 1.5%. So we've seen a significant rally in bond markets over this period. From an asset allocation point of view, when we think about what does the outlook hold for both high risk asset classes such as equities as well as fixed income markets, our core view is that we really need to maintain a balance across those. The challenges that we're seeing and the lack of really policy consistency coming out of particularly the US is really making it very, very difficult for investors. So when we think about our asset allocation, when we think about particular market segments, our view is that we're trying to balance those risks accordingly. So as I said, we've selectively increased our position in bonds. We're maintaining a reasonably high equity exposure, but equally we're looking at alternative investments as another part of the portfolio in order for us to be able to, as I said, balance out those risks while generating what we believe to be appropriate returns. As always, if you have any queries in regards to your own personal circumstances, really important to talk to your financial advisor, and look forward to catching up with you next month. Bye for now.